right. I believe we're at the 4 o'clock mark, actually just a little bit past. So let's begin. The webinar again is being recorded. Good afternoon, everybody. Welcome to Azzad Asset Management's 2016 Market Outlook. You're joining us during a momentous time. The Fed just raised interest rates, as some of you may know, as of yesterday. It's first time in 9 years. Central banks overseas continue to push a very dovish monetary policy to try to revive their economies. Back here in the U.S., the S&P 500 is closing its third quarter reporting period with another showing of negative earnings growth, which is the definition actually of an earnings recession when you have 2 consecutive quarters of negative growth. In light of these developments, I'm guessing you might have some questions for our expert here today, who will be joining us momentarily. So some of those might be, are markets poised for an even bigger sell-off than what we saw in the late summer of 2015? Or maybe we'll see a return to growth in certain sectors. Is that possible? So today's webinar is going to examine those questions in general, and also take a look at the likelihood of an eventual reprieve in 2016 and explain the reason or reasons why we think there are opportunities for growth if investors, that is, are picky and choose the right sectors. So very quickly, we'll do a quick rundown of what we're going to be discussing today. Christian Greiner, portfolio manager for the Azzad Ethical Fund, is going to discuss where things have ended up as we bring 2015 to a close, and we'll conclude by looking at the sectors that we think could benefit next year, as well as those that investors might consider avoiding in 2016. Moving right along, let's do the introductions for today. Meet the lineup. Your presenters for today will be, as I mentioned, Mr. Christian Greiner, Vice President at Ziegler Capital Management and Portfolio Manager of the Azzad Ethical Fund, which is our mid-cap growth mutual fund. Christian's going to be joining us in just a moment to offer up his perspective on the year that was and to talk a little bit about where to look for growth going forward. I'm Josh Brockwell, Investment Communications Director here at Azzad. Quick word from our sponsor to give you a little bit of background about Azzad if you're not familiar. We're a boutique firm located just outside Washington, D.C., rainy Washington, D.C. today. We're registered with the SEC as an investment advisory firm and sponsor 2 halal mutual funds, including the Azzad Ethical Fund, which we'll touch on today, as well as model portfolios for institutional and retail clients. So moving right along, quick word about our philosophy. We're probably different from some of the investment advisors that you may come across, and one of the reasons for that is our dual mission philosophy. This is a mission, of course, that focuses on generating competitive, long-term financial returns, while at the same time using investment capital to promote a just and sustainable economy. Our vision is a world in which investment capital helps to have a positive social impact. As such, all of our products and services comply with halal investment guidelines as established by the Accounting and Auditing Organization for Islamic Financial Institutions, or AOFI, which you see there on your screen. We're also a member of the Forum for Sustainable and Responsible Investment, as well as the Interfaith Center on Corporate Responsibility. So with that, let's now turn to the first section of today's presentation, where we've been and where we might be headed. I'll now turn things over to Mr. Christian Greiner. I'll ask him to show us his pretty face, as well as unmute his line so he can kick things off with the 2016 Market Outlook. Christian, good to see you.
Hello, Josh. How are you doing today?
Doing well, thanks. You're coming through loud and clear.
Excellent. Well, Josh, I'd like to put into perspective what worked in 2015, and we'll do that really here in one slide. It's always tough to be in a year with the volatility that we've seen, but it's a good exercise each year to take a step back and see what worked in that big picture. In 2015, if we take a look at industries, we show that retail was up on top. I have an asterisk there, though, and that's really because retail's return is a top-heavy type of return. The 100% plus returns of Amazon and Netflix stock, as well as some other winners like Home Depot, mask the fact that 70% of retailers underperformed their industry's return. And that was the theme this year, something that we call narrow market leadership, where you have a few leaders drive the bulk of the returns for the market. Other industries that worked were software, consumer services like restaurants and hotels, companies that make food, healthcare. By no surprise, energy stocks were among the worst performers of the year. Transportation stocks also underperformed, which can be seen as sort of a foreboding sign for the market and really the economy in general. Materials stocks were sold off. If you think about all the negative headlines surrounding miners and metals prices this year, that's not really that big of a surprise either, while tech hardware and auto stocks also left something to be desired. Looking at a broader picture, growth stocks had another great year, as we will get into later. Large caps did better than small caps. Price momentum was really the factor that drove a number of returns rather than valuation, and developed markets did better than emerging markets, something that we've seen here over the last few years as a trend.
Okay, Christian, so thanks for kind of giving us a recap of where we've been. We see that now. Can you talk to us a little bit about where we might be headed?
Well, sure, Josh. At this time of year, I get a lot of reports previewing the year ahead. Excuse me. Usually these reports are pretty optimistic in terms of tone and market outlooks. This year, there seems to be a lot of uncertainty, and it's hard to find someone who thinks that equities will really have a stellar year next year. Where we stand now, S&P 500 earnings estimates are calling for 18% EPS growth in 2016, led by the discretionary, healthcare, and tech sectors. These are aggregated from analysts on individual companies and usually give you a pretty rosy forecast. We expect this 18% figure to come down pretty significantly as the year goes along. They usually come down as the year goes along, but for this, these were backloaded into the second half in terms of gains for 2016 in terms of earnings, and we expect that to really come back to earth. Market strategists, which we would call more of the top-down earnings estimates, they're calling for growth around 8.5%. Still pretty rosy, but something that's a little bit more reasonable here. The average S&P 500 target is currently just 2145, and that's not much of would be for year-end 2016. It would be that 2145, and that's not much of a rise from current levels. So that sort of points to a flat year for 2016, even after our recent sell-off. A lot of these pieces go into detail on four main themes, some of which we will touch on today. The Federal Reserve rate hike and what timeline future rate hikes might take, the effects of low energy prices on different segments of the financial markets. Is this a top for the strong U.S. dollar here? And will global growth reaccelerate in 2016? Will China engineer a transition to a consumption-based economy? Will Europe's monetary policy easing have a positive effect? So I'd also like to take a look at a couple of indicators that seem to be giving the market some pause. The first of these is the forward price to equity ratio, what the market trades at in terms of expected earnings over the next year. The market is trading at some of the highest levels seen in the last 10 years, but it really isn't willing to push it up much higher past the 17.5, 18 level. From a PE perspective, a market goes up because earnings go up or the multiple expands. We're seeing signs that in 2016, we can't count on multiple expansion. It's going to have to come from earnings growth. Another sentiment indicator I like looking at is how stock prices react to companies buying back their own stock. In theory, if a stock is undervalued by the market, a company going out and buying its own shares on the open market is a good thing. For the previous 5 years, this was true. The S&P buyback index went up at a quicker rate than the S&P 500 in general. This also has the effect of reducing share count for a company, and that boosts earnings per share growth. In 2015, we can see that this S&P buyback index has really started to underperform the market, hence the downward trend on that line. So that's telling us that the market is more wary of companies buying back their own stock, and that's an indicator that the market may think that a lot of these companies have reached fair value, and the company or companies would do better using their cash for investment or for other purposes.
Okay, Christian, so as we transition here to slide 12, let's talk a little bit about this earnings recession, and it's something I hear a lot about. I understand that 98% of the S&P 500 companies have reported their third quarter earnings. and profits have contracted. I think it's something like 1.7%. They fell also about 0.4% in the second quarter, which is, as I mentioned at the top, the definition of an earnings recession. We have 2 consecutive quarters of negative growth. And I'm also seeing projections for the fourth quarter that are also negative. So just for the concerned individual investor out there, the theory, as I understand it, is that earnings ultimately drive the business cycle, and it's rare for earnings to decline persistently without triggering a recession. So this is a big concern for really everybody, market participants or otherwise, right? Weakening corporate profits, this is the theory. Again, they weaken capital investments, which in turn hurt labor markets and thus consumer spending. Is that a safe or fair assessment in your estimation?
Yes, Josh, that's a pretty fair assessment, and this market seems to be concerned about an earnings recession. It's also fair to point out that an earnings recession can happen without an economic recession. We've seen earnings recessions before, especially sort of mid-cycle slowdowns, and then we see a reacceleration without a true economic recession. And you're right that an earnings recession is 2 consecutive quarters of year-over-year earnings declines for the S&P 500. But these future projections might be a little pessimistic right now. We're going into the fourth quarter of 2015, and usually when a quarter starts reporting, companies beat analyst estimates, and you see that number start to rise. So I expect that number to be flat to slightly higher in Q4. However, what's more important than projections is why we're seeing this trend. And this graphic shows what has caused this earnings recession. Share repurchases have goosed that EPS figure by 2.2%. Companies have once again been able to grind margins higher, and however, revenues are down 3.3%. Some of that is the effect, the currency effect, the strong U.S. dollar on international sales, and a good amount of it is also the trauma that's been caused to revenues and earnings in the energy sector.
Okay, that makes sense. So with that, where might we be headed in the coming year?
So in 2016, earnings growth, as we talked about earlier, it's expected to come from a return to revenue growth, more margin expansion, and some more share repurchases. We'll go into why it might be tough for revenues to rise and really for margins to expand in a bit.
Okay, so a little bit of a teaser there. So let's change gears and talk a little bit about the news of the day, or really the news of yesterday and today, and probably the news in markets at least for a little while now, which is that the Federal Reserve, has just raised interest rates for the first time in something like 9 years. Help us dissect that a little bit, Christian.
Well, the Federal Reserve finally raised interest rates, and it was the first time in 9.5 years. And we had a good time here yesterday reminiscing where we were almost 10 years ago when this happened. 2015 has served as a nice reminder for all of us that nothing is certain with our central bank in terms of timing and when they're going to act. But right now, the market's pricing in 2, maybe 3 more rate hikes in 2016, depending on the indicators you look at. The timing and magnitude of those hikes is still up for debate. For equities, a slow rate hike cycle might be the best course, as it would ease concerns about multiple contraction. This Fed has said repeatedly that they are data dependent, so it would be rational to think that they might watch what effect this first rate hike has had before moving again. And this liftoff is different in terms of timing. GDP growth is only 2.25%. Average GDP growth rate at a first rate hike over the last few cycles has been 3.4%. The other important point is that the U.S. dollar has already started to rise ahead of this move. Usually we really started seeing that accelerated move in the dollar during the rate hike cycle. So the expectations in the market right now are for a gentle hike and a gentle path there, as we can see with that red line. This busy graphic is the Fed expectations dot plot, where the Fed officials each predict where they think the Fed funds rate is going to be at the end of each year. The red line is where the market is pricing, what the market is pricing in. While we can see that the Fed has lowered their predictions for future fund rates as the year goes on, and they did so again in this last meeting, the fixed income market is pricing at a much slower rate than the Fed. If the Fed does stay true to its course that we see here in the dot plot, the market will be surprised, and there will be some implications for the fixed income and equity markets.
Okay, fair enough. So this next slide is actually one of my favorites. I remember from our webinar during the summer on active versus passive investing, which shameless plug is on our YouTube channel, youtube.com/Azzad Funds. Christian, walk us through this one.
Well, that's right. This is one that I have on my desk here. And we're breaking out this chart again just as a reminder that rising rates are not necessarily bad for stocks. This plots weekly S&P 500 stock returns and interest rate movements. It isn't really until you have a 10-year Treasury yields approach 5% that higher interest rates mean lower stock returns. With the 10-year yield currently at about 2.25%, we're still firmly in the higher interest rate, equal higher equity returns territory.
Okay, and like you said, we've used this chart before. This time, though, I think you have others that go into a little more detail, correct?
That is correct. This next chart shows what we might expect now that rates have been raised. Each particular rate hike cycle is different in terms of tenure and how the market reacts, but stocks usually do sell off slightly after the first rate hike, but they do return to positive territory about 6 months later.
Okay.
And a year later, as we can see by this chart here, they're higher by about 6% on average. And what we see is that those gains come from stronger sales, better margins, higher profits, rather than multiple expansion. We can see that the multiples, and we're talking PE multiples here again, shrink by 10% on average in the first year after a rate hike.
Okay, so you've evoked the strength of the U.S. dollar earlier. Let's talk a little bit about that and its potential impact on markets. I think we've got there's a screenshot of its meteoric rise of late.
And that is really a telling chart there. The strong dollar has really started to make headlines as 2015 progressed, and for good reason. The dollar is arguably in the 7th year of a bull market, dating back to purchasing power parity low in 2008. The effects of a strong U.S. dollar can be felt across different U.S. markets and really the globe. From our view, there are a couple aspects of a strong dollar that concern us. A strong U.S. dollar, first, of course, reduces company profits. Every company that has significant overseas operations have been talking in their earnings calls and in their filings about the negative effect the strong dollar has had on sales and on their overall competitiveness in foreign markets. There are other effects. Some of them are positive. The U.S. consumer paying less for imported goods may feel richer and may spend more on domestic goods and services as their sentiment improves. A strong dollar can also draw foreign investment into the U.S. In the past has served as a check on inflation. But right now, from what we can see from economic data, inflation is a relatively small concern for the U.S. right now. So this left chart shows how over the last 5 years, the markets have oscillated in terms of how the strong dollar may have affected the market. The recent drop-off in correlation between the S&P 500 and the trade-weighted dollar has shown that the strong dollar is really now serving as a headwind, with most of the concern being over future U.S. profit growth. In earlier years, there were a lot of good things going on in terms of global demand and the economic cycle, so that a strong dollar wasn't really seen as a threat. Hence, we can see all the green there. Now that we're close to the part of the market cycle where it's getting really hard for margins to expand and we're looking for new places to grow revenues, it's seen as an issue. So this next chart that we have here, the historical effects of a strong dollar on earnings. Top of the U.S. dollar comes with a big drop in operating earnings for U.S. stocks. While we're seeing an earnings recession now, we're not seeing a large drop in terms of earnings. It's still a relatively shallow dip in terms of earnings contraction. We might not be at the peak of dollar strength just yet. If the ECB and Bank of Japan continue to take easing actions while the Fed tightens, the dollar could get stronger, and that will hurt these overseas earnings. One way to look at it is that for every 5 or 6% move in the dollar index higher, it should take down U.S. earnings estimates by 3% and reduce U.S. GDP by about 0.5%.
Okay, thank you, Christian, for that tie back to the discussion about earnings earlier. So now let's take a minute here. We've kind of outlined a lot of the headwinds facing the markets. I'm hoping at this point you'll have some good news for us or reasons for optimism.
Oh, definitely. Us equity guys are optimistic by nature. That's why we're in this business. And we've got a lot of variables working in our favor here. The first of these is the strong U.S. job market. The recovery from the financial crisis has been slow. It's sort of been plodding and, of course, very uneven. But it appears to finally be building a head of steam in the U.S. employment market. The second is the possibility of a slower appreciation of the dollar. We're in the 7th year of a dollar bull market. The last couple dollar bull markets have lasted about that long, 7 years. As we saw when the ECB surprised the market around a month ago in terms of their actions, there's a lot of bullish assumptions baked into this dollar. And if those aren't met, we could see those dollar headwinds become more benign for U.S. companies.
Just point of order very quickly. ECB, of course, is the European Central Bank for the uninitiated, because we have a combination of both individual retail investors as well as advisors on this call. I just want to point that out.
Well, thank you, Josh. Lower raw material costs. The price of oil isn't the only thing that's lower this year. The prices of many commodities, from iron to corn, have fallen, and that could help some companies' bottom lines, and we're starting to see that come into some of their commentary. Lower corporate interest expenses. Companies with debt on their balance sheet have locked in low fixed rates for an average length of 9 years. This could help earnings margins for years to come. Trailing price to equity ratio valuations are not pointing to a market peak just yet. We'll see something about that here shortly. And consumer sentiment readings are still pretty robust in the U.S. We talked about that strong dollar, but we also have to think about the fact that U.S. is close to full employment. People are going out and finding jobs. They're getting raises. The price of gas is lower. That all makes for a pretty rosy U.S. consumer, not to mention the fact that they're starting to get some equity build up in their homes again. And there's always the possibility that China, Europe, Japan, one or all of them surprise to the upside in terms of economic growth, and that would drive some overseas earnings.
Okay, great, Christian. Thank you for kind of both sides of the coin there. It's going to bring us to our last section of today's webinar, which is where is an investor likely to find growth opportunities in 2016?
Well, one of the most interesting things going into 2016 is that wage growth might accelerate in 2016. Economic equality has been a big theme for politicians to hit on, and this chart is really one of my favorites that addresses this. The green line shows how the workers' take of economic profits that a company makes fell in 2001 below its long-term average, where profits going to the corporate structure, as we can see with the black line there, rose almost in mirror image. We might be seeing a stabilization or a reversal of this trend on a long-term basis here. It's too early to call that, but it's something to watch. One of the drivers behind these record high profit margins I have been talking about has been these lower labor costs. If wages rise, these margins could theoretically come down. However, if more people have more money to spend, some of that could show up in company revenues. Businesses might counter this trend by finally investing in productivity increasing tools and equipment, which may push revenues higher for certain industrial and tech companies. This chart shows that in the recovery, the average hourly earnings growth has not caught up with employment gains, as we would expect to see. We'd expect that blue line to sort of be moving up in concert with the black line there. Now we're hitting full employment, we're starting to see it really start to move up there. We're just really starting to see this tick higher, and that's why people expect to, and what people expect to be paid in terms of raises over the next 12 months is also rising.
Okay, so moving right along here, I understand this next chart shows price to earnings ratios throughout history. I do hear a lot, Christian, about this market potentially being fairly valued or overvalued, perhaps. What does this slide actually show us?
Well, I like this graphic as a student of market history, and it's something we discuss here pretty much every week in our portfolio manager earnings, and there is a feeling that this market is currently fairly valued for where we are. What we take from this, though, is that the market's currently at about 17.8 times trailing earnings, which aren't at the average levels that we see at tops of markets, which usually happen closer to the 20 times trailing 12-month earnings. When we see it go to 20 or above 20, that's when we start talking about tops. This bull market is long in the tooth. It's been going on, of course, since 2009, but it's really isn't close on a valuation, close to these euphoria levels that we've seen in the past with sort of blowout tops to end a bull market.
Okay, so there may be more room to run then.
That is correct.
Excellent. So with that, let's try to put the talk into perspective here and discuss growth stocks versus value stocks, because as we know, these two styles of investments are sometimes at odds with one another. And as the PM or portfolio manager of the Azzad Ethical Fund, it's a growth-oriented fund. It'd be interesting to get your take on where you see growth going in the future and kind of where it's been this year.
Well, this year the difference between growth and value equities has started to capture the financial press's attention. This first chart shows us that as of December, growth has outperformed value by a cool 10%. That's a gap we really don't see too often between these two indices. However, this is a continuation of a trend that we've seen since 2006. To make it simple, when that green line is rising, value is outperforming. When it's falling, growth is outperforming. Growth's dominance over value is about as long as we've seen since the 1960s. When we see a trend like this for so long, we start looking for reasons. And this chart shows that it versus the 10-year U.S. Treasury and its falling rates. So as rates have gone lower, growth stocks have outperformed. From an asset valuation theory, this makes some sense. Value stocks' appeal is based on their short-term cash flows, be they profits or something more concrete like dividends. Growth stocks' value lies farther out. These are profits that might come later on because they aren't done growing yet. Their earnings power is yet to come. The lower interest rates go, the lower the discount rate we use to value these growth stocks. The lower the discount rate, all else equal, the higher the theoretical value of these growth stocks. Another theory, of course, is that sluggish growth environment, investors will put a premium on stocks that exhibit growth potential. And that premium really has been seem to have been rising lately. So when we look at a trend like this, our minds naturally start looking at when and why it will end. One of these reasons might be that value stocks have become underloved by investors and hence undervalued. However, if we take a look at trailing 12-month ratios, we might not have reached that point yet. We haven't quite hit the levels of growth infatuation that we did with tech stocks in the early 2000s, or for some of those out there that might remember, the Nifty 50 phenomenon that popped the bull market in the 1970s. Value and growth are trading at their relative PE mean right now there, as we can see by the dashed line.
So for a growth-oriented investor then, Christian, how should one navigate these waters?
Well, when this trend I just outlined turns, it might be quick. A number of market strategists this year have been pointing at this as the year of when GARP investing might be prudent. And GARP stands for growth at a reasonable price. These are growth stocks that are also in the top quintile of cash flow to price valuation metrics. These stocks tend to outperform in times of market weakness. Some sectors have more GARP names than others, depending on where we are in the economic cycle. But usually you can find a GARP name in most sectors if you look hard enough. So with that in mind, I'd like to talk about how one might position themselves in their portfolio going forward. One of these might be overweight the consumer discretionary sector. Low energy prices should be a tailwind for them. The gas dividend that many assumed would push these stocks higher didn't manifest as expected. And when we talk about the gas dividend, we talk about the theory that people will take their what they save on lower gas prices and go out and spend that in the economy. It looks like people were saving that gas dividend instead of spending it through most of 2015. Auto sales and big ticket items saw some nice increases and maybe were benefits of the gas dividend, as some will argue. at the expense of smaller day-to-day purchases like apparel. One caveat is to look for in the discretionary sector is that if we are going to have rising wages, these companies' bottom lines might be hurt more severely than other companies. Technology is also an attractive area. The effect of the strong dollar on earnings should anniversary out and perhaps wane. And the sector trades at a discount to the broader market in terms of growth and profitability. The sector has some of the strongest balance sheets in the market. They have a lot of cash on their balance sheets, and which may drive another wave of mergers, as we're seeing in the semiconductor arena right now. With that, there are areas of the market that are tougher calls. The industrial sector saw some good performance from commercial and professional services this year, and in aerospace and defense names. However, a lot of capital goods names that sold their goods and services into the energy and material sector, we're still seeing some weakness there, and we're still seeing weakness in the economically sensitive transports, which we talked about a little bit earlier. That would be, your railroads and some of your truckers. Healthcare has some of the most compelling long-term growth characteristics, but valuations in this space have become a bit stretched, especially when you're talking about some of these early-stage biotechs. The sector also faces some undue headline risk in this election year, with the affordability of healthcare access, drug pricing, and that could hurt sentiment in the space or in specific stocks. And materials might actually be one of the most interesting sectors of them all. Miners and metals are, for the most part, are going to be the purview of deep value investors for a while here. There might be some growth opportunities in chemicals, especially as they deal with low energy prices, and also really in U.S. construction materials as commercial and residential housing continue to rebound nicely, as well as the packaging space. Now, taking a look at some areas where we might want to exercise some caution this year, we're still cautious on the energy space. The dynamic between OPEC producers, non-OPEC producers, and the U.S. shale patch is, well, for lack of a better term, evolving. There isn't a lot of real true growth plays out there right now, especially in terms of profits. What we currently hold in the fund are names that will benefit from industry consolidation, and when the industry turns, these should be better for it. Consumer staple stocks are very sensitive to rising rates. A lot of investors looking for some kind of bond substitutes when we had these low interest rates took shelter here over the last few years. And when rates rise, that might change. The total return yields to shareholders for consumer staples overall are declining, and they have a high relative valuation to the market right now. So that really brings us to what we're looking for in terms of a broader perspective for the Azzad Ethical Fund as we move into 2016. And right now what we're looking for are clear margin expansion stories. These should be at a premium in the coming year. We're looking at companies that have relatively high U.S. sales exposure in case this strong dollar continues. Until we start seeing some dollar weakness or renewed economic growth overseas, this is where we're going to be looking. A couple such examples of companies are Tractor Supply Company or Ross Stores, which we brought in earlier this year. We're looking at stocks at the larger end of the market cap size for the mid-cap growth universe. This could be seen as more of almost as a safety trade in a way. We expect the growth regime to continue, but we're going to be watching those relative valuation metrics that we showed earlier against the broader market closely this year. And as a measure of safety, as usual, we always look for strong balance sheets here at the Azzad Ethical Fund.
Okay, thank you, Christian. With that, we're going to open up the conversation to questions from the folks joining us today via GoToWebinar. Everybody, if you'd like to ask Christian Greiner a question, please do so using that question feature on the control panel of GoToWebinar. I will use the presenter's prerogative and kick things off with actually a question that isn't directly related to this presentation, but one that I wanted to respond to nonetheless. We got a question in advance from an attendee asking about the effect of higher interest rates on real estate. Now, I don't expect Christian to answer that, but I do want to emphasize that at Azzad, in addition to the Azzad mutual funds, we offer separately managed portfolios, one of which is a real estate investment trust portfolio. We have a white paper on real estate investment trust investing or REIT investing that should be out on the website this weekend, so I would invite you to take a look at that. That's on azzad.net. You'll be able to read a little bit more about the perceived effect of interest rates on real estate there. Now, with that little bit of business out of the way, I'm going to go over to the question box here and see if there are any other questions from the attendees. A reminder that you simply have to click on the question box. And okay, there are a couple coming through here. Another question about the REIT fund. Is it Islamically compliant? Yes, it is. As is everything we do here at Azzad, our products and services comply with AOFI guidelines. You can read more about those again on azzad.net. Actually, I think you'll appreciate some of the accolades we've received from that REIT portfolio in particular. We've got some decent recognition from databases and pundits of late. Any other questions related to today's webinar, specifics of Christian's talk? A couple others I think are coming through here. Yep, and as folks are typing, I see that happening. Christian, I'm going to ask you a question about, well, it's more of a general kind of toss-up, but I am going to ask about the prospect of going back to the Fed raising rates, the prospect of the Fed doing that in light of this earnings recession. I saw something the other day implying that it was the first time that's happened in something like 5 decades. So isn't that sort of a risk of sort of putting an obstacle in the way of this recovery that's been going on over the last few years?
Well, I think, Josh, that there's a couple ways to look at this. First off, as we talked about with earnings recessions, often these are mid-cycle occurrences that can happen. The second is even with this rise in rates, interest rates in the U.S. are at historic lows. These aren't going to be affecting financing decisions in the U.S. just yet. I once again want to bring it back to that 5% threshold there in terms of treasuries. So I think that we would still have some room to run, and I'm sure that the Federal Reserve is very cognizant of the fact that they have some room to work with there. That being said, I think that they will take time between this one and whatever next rate hike there will be to see what the effects are on terms of earnings and capital spending, on consumer sentiment and business sentiment.
Okay, excellent. And with that, I think we're about 40 minutes into the webinar, which might be a good time to pause. I'll give folks one last chance to ask a question or two. Otherwise, we will hop off here. I believe that there may be one other question coming through. And just a reminder, if you do have any questions at any point after the webinar, you can always feel free to give us a call here at 888-86-AZZAD or drop us a line, info@azzad.net or info@azzadfunds.com. I think there is one more question coming through, but with everyone's time and schedules in mind, I'm probably out of respect for those things going to go ahead and call it an afternoon. I'm going to direct everyone's attention to the disclosure section of the presentation. Compliance always appreciates it when I show this slide. I invite you to read it at your leisure. Again, the webinar is recorded. Hopefully it'll be up on our YouTube channel in the next 24 hours or so. I invite you to go immediately to this slide, pause it, and read all about our risks and charges and expenses and objectives. But with that, I'm going to one more comment or two coming through. Thank you, everybody. We appreciate your attendance, and we appreciate the fact that you're attending live, and we always feel like that's a good opportunity for folks because you're able to talk directly with the folks that are managing your money. In this case, it's Christian with the Azzad Ethical Fund. I do have one more question, Christian, if you don't mind.
Oh, no problem.
That you might have to run. Okay, excellent. Then in that case, I got a question asking about the, in general, is it true now that the risk in investing in the current market is relatively higher than the potential returns? Oh, so it's a question related to some of the slides you talked about, but specifically does it make sense for somebody to even be in the market right now in light of the risks? That's probably one we should address before we hop off.
Well, I think it does make sense to be in the market as long as you have a, and once again, this really goes to whatever an individual's risk tolerance is and what their situation is. But you know, this is a market that is, even if it is fairly valued right now, there are still opportunities within this market, and there are opportunities for investors to take advantage of. And so with that, it is a good time to be in the market. It is a good time to have an exposure. It's always good to take a look, especially on a yearly basis of where you are in terms of your risk appetite and your asset allocation, but it is a good time to be in the market.
Great. So with that, we'll conclude today's presentation. Thanks, everybody, for your time. Of course, I want to thank Christian Greiner from Ziegler Capital Management for being with us today. Please visit our website, azzadfunds.com and azzad.net, where you can read more information about our mutual funds as well as our separately managed portfolios, one of which I alluded to earlier. As the disclosure slide noted, the prospectus is going to contain a lot more information about the fund's risks, expenses, and investment strategy. While there, on our website, you can also sign up to receive our monthly e-newsletter, which offers more information about our products and services. Finally, just a quick note to like us on Facebook and follow us on Twitter. The Facebook address is facebook.com/Azzad Funds. The Twitter handle is @Azzad Funds. And again, a recorded version of this presentation will be available on our YouTube channel, youtube.com/Azzad Funds, hopefully within the next 24 hours. Thanks, everybody, for your time, and have a great afternoon. Thanks again, Christian. Appreciate it.
Thank you.